Coming up today, Tesla shares continue to rip higher. JP Morgan says fade the rally. David Einhorn gets bullish on Peloton. Consumer sentiment hits a 6-month high. The latest global macro, and is the market about to get rocked by the election? You don't want to miss this one, guys. Let's go. And welcome back, everybody, to the Daily Market Review. As we round out this week on Wall Street, market's still pretty much trading flat here, like they're in wait-and-see mode. Still got the Trump trade on fire, though. DJT ripping up over another 11% today on volume. This thing is a steam train that can't be stopped as the markets continue to price in a Republican win, which we are quickly approaching. Next week, the last full week before the election the following Tuesday, getting down to crunch time here. And we can see markets pricing in who's already won this by looking at a lot of different assets. Clean energy been selling off really hard this last month, while other stocks like domestic industrials, construction companies, they've been holding up pretty well this last month. Option deal is still on edge here, still demanding a premium, thinking we may get a rug pull before the election. If not on the election, they have to price in the possibility that the markets could be wrong. However, stick with me today because we'll dive into this and a lot more later on. First, just taking a quick look at what else is moving out there today. Palantir ripping up, closing at a new all-time high, and with that becoming a $100 billion market cap company for the first time ever. This has been one of my biggest winning positions this year, and the solid uptrend appears to be intact. Another area of the market we've been doing well in, uranium nuclear, that trade. Having a bit of a bounce today after we pulled back to start the week. There's a look at Lightbridge. And the company backed by Sam Altman, Oklo, bouncing back a bit as well, as nuclear uranium stocks absolutely surged over this last month. Starting to get a little bit of action in the lithium stocks as well. There's LAC pushing up on a really nice candle here. May have put in a rounded bottom. Also got a little bit of a bounce in solar stocks today, in addition to lithium, as they too have been traded really weak on the expectation that government and regulatory support for clean energy industries may decrease over the coming years. However, that narrative didn't stop Tesla ripping up again today, 3.3%, doing pretty good in a soft tape. Finishing near the highs, and that's the highest closing price it's been all year after it had a pretty soft start there. Now close to taking out those highs, just a couple of points above where we are now, 271. And I don't know about you guys, but that kind of looks bullish to me on the monthly chart. It's been trading sideways. 3.5 years, we appear to be pushing up to the top of this range. And so this will be the next key level. Technically speaking, it has to break through before we can start saying with confidence it's in a new uptrend. So pretty much above that big psychological $300 level, which I've got a feeling we may just do over the coming months, barring any surprise from the election. However, at the end of the day, it doesn't really matter who's in the White House. I think Tesla can succeed regardless. And it's also reassuring to me to see the bears are out in full force, doing their best to keep you out of the stock, just as they have done for years. And I'm not just talking about the online furus either. Even an analyst from JP Morgan have their doubts about this earnings quarter, saying the growth drivers aren't sustainable, questioning their regulatory credits, and just doubting whether they can continue to grow in the current environment. And in fact, went as far to reaffirm their sell rating and actually came out and said, fade the Tesla pop because their earnings boost is unsustainable. Keep in mind, this is the same JP Morgan in January last year, 2023. Came out with an underweight rating, said it's on a bearish trajectory, and that was back here, January 2023. Huge consensus for that it was over for Tesla. Elon was just taking over Twitter. He had to sell some Tesla stock. Everyone jumped on CNBC, all over social media, said it's going to $50. And this is when I started my channel, Click Capital, and you can go back and watch my daily market reviews from back then. I was calling for a Tesla bottom based on my fair value indicator, technical signs. It actually turned out to be a great time to buy the dip. We got down to those low 100s. So that's when JP Morgan was bearish on the stock, say it's on a bearish trajectory. And this is also the same JP Morgan that also owns 32.2 million shares of Tesla, currently worth 6.3 billion for their clients, some of the richest people in the world. So like I said, there's Chinese walls and investment banks. What you hear from the sell side and what they're actually doing on the buy side are two different things. So just because one JP Morgan analyst puts out a research piece, the mainstream media jump all over it, along with everybody else online. Don't be fooled. That's not JP Morgan, the bank, being bearish on Tesla, being short Tesla. Like you can see in their 13F regulatory filings, they actually own billions of dollars of Tesla stock. However, there's plenty of skepticism all across online, saying it's not sustainable. There's really good earnings. Could be a one-off blip. People just can't seem to get their head around the regulatory credits. And we've got other clowns like this. Ross Gerber. It was previously a Tesla permabull. Then Elon came out in support for Trump. And since he suffers from stage 5 TDS, that just caused him to have a meltdown. And ever since, go on one TV show after the other, talking bad about Tesla and Elon. In fact, he said right before the earnings, it's probably better to be a seller than a buyer from a valuation perspective. Stock went up 22% the next day. And Ross Gerber actually has an ETF on the market, Gerber Kawasaki ETF, under ticker symbol GK. Been on the market for over 3 years now. Here in the pink is S&P 500, which is literally off the charts. That's how much his ETF has underperformed ever since it came on the market. Still underwater. So just be careful who you take advice from, whether they even have a track record, and if they do, just check it out. It was also nice to see probably one of the best contrarian signals out there. Cathie Wood and her ARK funds selling Tesla stock. Said late Thursday, ARK Innovation sold 77,513 shares of Tesla. Again, just look at their track record. Cathie's normally been a Tesla bull, but her trades and timings, some of the worst out there, as she runs actively managed ETFs. Totally missed the boat on Nvidia and the AI boom, even though her ETF's called the Innovation Fund. Sold out of Nvidia at the bottom, and in fact, in net total, looking at all the funds investors have put into ARK funds, total net, they've lost over $14 billion. And that's why the respected Morningstar calls Cathie Wood the worst wealth destroyer. And there's a long-term monthly chart of ARK Innovation. It's been on the market for 10 years this month. And why investors have lost $14 billion cumulative total is because for some reason the media parades her around, which she did a lot in 2020, 2021, attracted a lot of newbie investors. They invested and have since sold at a loss after the fund crashed. And again, for comparison, since she mostly invests in NASDAQ stocks, there's the Triple Q's NASDAQ index ever since she IPO'd. Up 388%, ARK Innovation up 133%. Somehow still got $5.5 billion assets under management. So my point is she's becoming notorious for some bad time trades, getting out of some of the hottest stocks at the worst time. And so I'd be more worried if she was adding to her Tesla position here. So I understand Tesla and Elon, controversial. A lot of people hate them. That's fine. But if you can separate that from your investing, I think you'd have a much better chance. Now, of course, nobody knows exactly what's going to happen in the future. Tesla could very well go down to $50 a share, like I'm told almost on a weekly basis. And like I always say, I hope I get that lucky. I'd love to back up the truck down there. But in my opinion, I don't think I will get that lucky. Technically speaking, and more importantly, what a lot of the bears miss, because they're just looking at a chart, is the fundamentals and how exciting the future is for Tesla. Of course, we're going to have market corrections, bear markets, we'll have a soft year or two. However, I'm talking about the big picture long-term thesis. And the fact that so many people hate him and hate Tesla, and it's the most shorted stock in the world. In my opinion, that just adds more fuel to the fire, more ammo for it to rip higher. And it's just so well positioned and one of the most dominant secular trends that has already hit us today. It's not like we're hoping this is going to happen. It's already happening. The adoption of electric cars and the explosive growth. Just 4 years ago, 3 million EVs were sold around the world. That number looks to have 5x to around 16 million just 4 years later. Huge growth. And so like a lot of leaders, I think people become obsessed and focused on their personality. And if they don't like their personality or some things they've said, they completely discount the things they've achieved, the data, the results, the actual effects from the decisions they make. And just listening to Jensen Huang, CEO of Nvidia lately, he called Elon Musk a superhuman for building out an AI supercomputer cluster in 19 days, in which Jensen Huang said that would normally take others years to do. And that's probably Elon's biggest strength, is his ability to not only multitask a lot of things, running all these different companies, but also his ability to create huge amounts of efficiency. That's why we've also got Oracle co-founder and chairman Larry Ellison, a big long-time shareholder and believer in Tesla, which has now made him one of the top 5 most richest men in the world. And he actually bit back earlier this year to a journalist right to their face who was carrying on this rhetoric. He actually said right back to them, "Who are you? Have you ever landed a rocket?" So even though it looks like a sci-fi movie, shooting rockets off into space, pulling them back down to Earth, doesn't matter that he can even do that. People will still doubt him, hate him. But like I said, I think that's just more to the benefit of the bulls and the believers that can withstand all this garbage. And like I said, technically, it's starting to shape up here on the monthly chart, right in the thick of this big resistance zone. From where we are now, 270 right up to 300. We get a clean break of that, we could be off to the races. But of course, a big part of that is the market. If the NASDAQ Qs take a dive, obviously that'll keep a lot of upside pressure on the stock. However, if not, I'm not sure if we'll see below $200 again. Maybe not. If we do, I'll certainly be there buying the dip again. So we've got a busy week coming up next week. First Friday of the month, so we'll be getting the jobs report first thing Friday morning. The Tuesday after is the election. Then we're getting into the thick of earnings. It's all happening. It's no wonder option dealers are jacking up their IVs. There's a look at the earnings calendar for next week. Big ones we'll be paying attention to. Tuesday after the close, AMD, Alphabet. Then Wednesday will be a real big one. Microsoft and Meta, along with Thursday. Amazon, Apple, and Intel give us a good taste at how some of the big mega cap tech have been doing this recent quarter. And as a group, they were really strong today, thanks to Tesla actually starting to break out here on the chart, while the rest of the market was a little soft. And Nvidia briefly overtook Apple to become the biggest company on the market today, getting above $3.5 trillion for the first time. And so that analogy from 1999, when Cisco briefly overtook Microsoft, I think it was literally for only 2 days before then crashing over the next few years. A lot of people thought that was the case with Nvidia as well. Back in June, it pretty much did the same pattern. However, it looks like Nvidia's trading pretty firm here, even though the entire semi sector is not. Seems to be well bid here, good seasonality, still got earnings 26 days out, and all we hear is these hyperscalers just can't get enough GPUs from them. So, I mean, unless the market has a little bit of a pullback, pretty much no reason for NVIDIA to as well. However, like I said, we can't rule out a little bit of volatility going into the election or even the night of the election if it's not a clear-cut result. Going to see futures get really volatile. The market may get a little jittery going into Tuesday after next, especially with the jobs report, bunch of earnings. We get any big misses from those mega cap tech or the unemployment rate comes in higher than expected. Currently 4.1% is what economists are forecasting. That would have come in 4.2, 4.3. That might make the market a little nervous about the economy. However, could be counteracted by Fed fund futures pricing in another 50 basis point cut, which some Fed members have hinted at they're open to do. On the other hand, if unemployment comes in at 4%, market may actually get nervous and dial back the prospect of a 25 basis point cut in November, 2 days after the election. But we've also had a bunch of hurricanes and strikes in the States that is likely to skew the jobs report and data. So we'll just keep that in mind when we talk about it this time next week. But looking at the prediction market, they're still pretty much priced at an end, 64% chance. Looking like a lock here, even though there's still media polls out there claiming the blue team's in front. Just looking at prediction markets, 2.5 billion wagered, and financial markets pretty much all had this pattern over the last month. So it would be a big upset and surprise if this weren't to play out, and we'd see a significant, swift, and sharp repricing across global financial markets. So that is a real risk over this next week and a half. We've also been hearing rumors online the E. coli outbreak at McDonald's may have been done on purpose. However, that's still yet to be confirmed, but the outbreak is growing, likely to affect their current quarter, potentially scare away some customers, damage their reputation, which just so happened a few days after they were used as a stage for a big campaign event. Stock getting whacked again today, down 3% on heavy volume. Doing a lot better, Peloton, after billionaire hedge fund manager David Einhorn thinks it could be worth 5 times what it is now. This was one of the hottest stocks from the COVID bubble. Wealthy consumers at home couldn't work, so they bought Pelotons, of which a lot of people have just dubbed them a treadmill with an iPad, just for 10 times the price of combining the two. However, David's bullish on the stock. He said if they can generate 450 million in EBITDA, about double its current projections, stock could reach between 750 and 31 a share. Pretty loose range he's got there. And there's a look at the daily on Peloton. It's been ripping up since its last earnings. Still burning cash, lost 8 cents per share, and it's going out to a monthly chart. A lot of these high-flying stocks from COVID look like this. Ripped up like crazy into early 2021. And this is what I call a crash. I know some people say when the market's down 3%, it's crashed. However, when a stock falls over 95% in a bit over a year, that's what I call a crash. So Peloton crashed, just like others like Zoom. Pretty much very similar chart. Everyone at home couldn't do business in the office, so they were Zooming each other. Market became convinced we're in a new paradigm. Everyone and their dog jumped on board. Stock shot up from $70 a share, almost $600 a share, and it too crashed over 90%. However, we're starting to see these stage 1 bases and accumulations in these former high-flying growth stocks, which I can see are actually still growing in their revenue. Free cash flow is actually accelerating for Zoom. Still in a technical downtrend, but very well could be pushing up this multi-year base as well. Same story again for PayPal. It too benefited from everyone staying at home, buying stuff online. I think it's fair to say PayPal crashed in 2022 as well, but it too looks like it's been accumulated and pushing up against the top of its range. A couple of stocks to keep an eye on. And so if these big brands, fast-growing large caps, can base out, break out, that's good for all the other similar, smaller names. High growth stocks that have been knocked down, as you'll find a lot of these stocks trade like a school of fish. And when the biggest move, the others can move as well. We've got reports today, consumer sentiment index rising to 70.5 in October. As a whole, Americans are feeling a little bit better. Price of gas has come down. Stock and property markets are holding up. They've been well pumped. Couldn't have a crash going into the election. Otherwise, that would make people question what's going on, more likely to flip. So we're getting reports the US economy has not only avoided a recession, it's growing faster. And I'd say that's what's been remarkable in this cycle compared to previous cycles. Normally, when the Fed hikes rates, and they actually hike them the quickest they've ever done, that typically knocks over the economy. Not too long after, but this time the economy's actually withheld those higher rates really well. And that's due in large part to businesses and consumers locking in low debt. So most Americans don't have floating rate mortgages like many other countries. A lot of Americans out there, especially the baby boomers, paid off their house. In fact, a lot of them don't even need an income and they can still live comfortably for the rest of their lives, just off their assets. Capitalism can come to a grinding halt. There'd still be plenty of consumers out there spending and buying things. Unfortunately, the government wasn't able to to do the same thing and lock in those low rates. Janet Yellen, for what she's been widely accused of, loading the front end of the Treasury's book with short-dated bonds, and which she's been criticized as purposely keeping low, keep markets on a sugar high, and she may have actually had, I would say, in my opinion, she's probably had a material effect on the bond yield curve, not to mention everything after COVID, and that cycle too could be getting tested. If we don't get a recession next year, I think it's fair to say the bond yield curve isn't the same as it used to be, which would actually make sense given the huge structural fundamental changes we've seen over the last couple of years. However, only time will tell. I nor anybody else can predict with 100% certainty that we will or will not get a recession. All we can do is follow the price action and just keep trading with the trend. Also interesting to note, whilst America conducts its federal election on November the 5th, China's parliament will hold a meeting from November 4 to November 8, covering that time of the American election. And I think they're waiting for confirmation that Trump's getting back in for the White House. And then to counteract potential tariffs, we may see a big fiscal package as they look to front run him. It also gives them ability to play it another way. If Kamala Harris were to win, we may see a flight from the US dollar, US markets, for which they may look to invite some of that capital into their own backyard. Either way, I don't think it's a coincidence they've set up their big meeting to cover the days before, the days after the election, as they're going to key off what happens there as part of their next move. And that's why Chinese shares as well, kind of in a wait and see mode, coiling up here. And they too may experience some volatility over the coming days and weeks. And so you could think of the US president as the most important person in the world, the most powerful and influential over global affairs, kind of can really lead the world one way or another. And so a lot hangs in the balance here. And unfortunately, current wars in the Middle East and Eastern Europe have only been escalating more and more this last year. We're now getting reports South and North Korea troops potentially entering the Ukraine war, in which they're reporting it's unlikely to stoke regional conflict. It's starting to shape up more and more as a global war. Now we're getting reports North Korean troops were sent to Russia. This could be potentially pulling in more and more countries, and in my opinion, is definitely going the wrong direction. And if you study history, you'll find a lot of kings and presidents, when they're on their deathbeds, one of their biggest regrets they often talk about before they pass away is regretting waging war, so much war, sending off their young countrymen to their own deaths for pretty much nothing at the end of the day. It's very rare one country successfully invades and overtakes another country. It just ends up in situations like Afghanistan, where Western troops were there for 20 years to try and get rid of the Taliban, only to hand it right back to the Taliban. Pretty much nothing changed except trillions of dollars wasted, along with hundreds of thousands of lives. That's pretty much how all wars end up. Also interesting to hear Xi Jinping starting to talk down the war, with him and Putin both reiterating they're open for negotiation. They want to see this war go away. In fact, we're getting reports China is actually cracking down on sending military goods to Russia. This is just a few days after Xi Jinping said the Russian-Ukraine war must end and denounced those who continue to promote it. So if these wars do get negotiated away, it'll be interesting to see how aerospace and defense stocks, the industrial military complex, holds up, as they've been performing super well these last couple of years. And in fact, even looking over the last 35 years, even though the S&P 500 put in a stellar performance in that time, the industrial military complex has done a lot better. And that's because there's been trillions and trillions of American taxpayer dollars funneled into these companies who then sell weapons all around the world. Some actually call it money laundering, because you'll get lobbyists from these companies in the industry actually help to shape foreign policy in Washington. Remember, it's always in their interest for forever wars, secures the constant flow of taxpayer money into their coffers. And that's where the criticisms come of the deep state, who are said to always want war, because at the end of the day, it's very profitable for them. And in fact, it's often undiscussed, but aerospace and defense, being one of the best performing sectors of late, just sitting below all-time highs, did have a bit of a sharp pullback this week. So we're paying attention to these stocks after the election as well. And if the wars are able to be negotiated away, that should help keep a lid on crude oil. At least take away the geopolitical risk premium, because the world is awash with supply and production. May actually cause a pullback in gold as well. However, these are big ifs. No magic going to happen overnight with what's happening in the Middle East and Ukraine. But I'd say a big part of gold's bull run has got to be due to the geopolitical tensions. Gold always performs well in that type of setup. It's been the safety trade because the usual long-dated treasuries have most definitely not. Bonds have fell ever since Jay cut 50 basis points, which has caught a lot of people by surprise. Also in news today, we're hearing the New York Stock Exchange is going to extend after-hours trading, getting to 22 hours a day. So at the moment, stocks currently open pre-market 4 a.m. till 9:30 a.m., the opening auction, and they trade at 4 p.m., the closing auction, then post-market goes to 8 p.m. So their new rules, they're looking at opening pre-market 1:30 a.m. and taking post-market to 11:30 p.m. And that's pretty much been the trend in markets over time now for quite a few decades. So we're basically moving to trading around the clock. However, there'll always be an open and close. A lot of financial products, mutual funds, index funds, stuff like that, they need an open and close price to calculate their net asset values, their NAVs, Also, a lot of institutions trade on the opening and closing auctions. Great place to find liquidity, get a midpoint, don't pay a spread. And so this looks like the natural progression for markets to be open around the clock. Keep in mind, pre and post market, very low liquidity, wide spreads. I certainly don't recommend trading outside regular hours, as the slippage is off the charts and the algos will beat you. If you think you can beat them day trading, good luck to you. In my opinion, and from all the stats and data I've seen, practically impossible. And just getting back into the charts, what's looking interesting to me is the growth sectors versus the defensive sectors on the monthly chart here, pushing up against highs, starting to shape up. Growth stocks leading. Same deal with consumer discretionary versus consumer staple stocks. Pushing up here, starting to shape up. I think it surprised a lot of people. With growth cyclical, consumer retail stocks started leading again. And speaking of retail stocks, there's the monthly chart on XRT. It too could be shaping up here. And so something I wanted to show you guys today is how market breadth can give us clues as to where the market's at, the strongest and weakest sectors, and at least how I as an investor look to position my portfolios. So what you're looking at here is the 11 S&P sectors, along with the S&P itself in the blue line, and the percentage of their stocks above the 200-day moving average, the long-term moving average. Got energy down here at the bottom at the moment, 31.81 here in the gray. Just like we can see in my sector breadth table, 31.81% of energy stocks above the 200-day average. Strongest sectors at the moment. When looking at long-term trends, financials, utilities, and REITs. Also not too far behind discretionary, industrials, and tech. And so the good news is now every sector except energy has more than 50% of stocks above their long-term average. Pretty healthy bull market. However, let's just scroll back in time and I'll show you something interesting and what I actually noticed back then as well. And that was the end of 2021. So the S&P didn't actually top out till the first few days of January 2022. The index as a whole was continuing to trade higher in 2021. However, you see a lot of sectors were pulling back even in Q3 going into Q4, giving us a big divergence from market breadth and the actual market. So that was our first clue the market was getting on loose footing. Most stocks were starting to go the other way. Then it kind of got a bit messy and volatile going into the end of Q4. And then what you want to pay attention to is here at the start of 2022. Most sectors took a big dive. What was different? The gray line, energy stocks. 100% of energy stocks were above their long-term 200-day moving average on the 7th of January. Clear breakaway from energy stocks. And you'll see that actually held up quite well, going all the way through Q1 into Q2. In fact, even into the second half of the year when they started peeling back and joining the rest of the market. And so just looking at a yearly chart of the S&P 500, 2022 was a down year, 19.5%. Some people call it a bear market because it met the technical definition with 20% from a high, blah, blah, blah. In my mind, it just looks like a correction and a secular bull. But anyway, so be it. And the NASDAQ as well actually finished down 2022, 33%, with sectors like consumer discretionary down 36%. However, the only sector that finished higher in 2022, energy, up a whopping 57%. Energy stocks were the place to be in 2022. Remember, we had inflation start to break out in 2021. Typically, energy stocks perform really well in that environment, increasing price of oil, and energy has the lowest correlation to all other stock sectors. So the XLE was up 57% on the year. And if we just go out to a weekly chart on XLE, remember how I showed you on the market breadth chart, right at the start of January 2022? Long-term energy sector breadth broke away from the market and held up there. And that's why it's always important to follow sector breadth and why I always show it on this channel. And this plays a lot into my investing decisions. How I choose my stock picks and a lot of things. So back then the play to be was rotating into energy stocks. That was becoming clear right from the get-go in 2022. And there it is on the weekly chart, XLE. Technically confirmed as well. Broke out, 52-week high, and had a really good 2022. Even though the S&P 500 certainly did not. So my point is, even though there's so-called bear markets, corrections, whatever, there's always a bull market somewhere. If not, entire sectors, stocks within them, ADRs, different asset types altogether through ETFs. You can pretty much access the world through the New York Stock Exchange. So many different exposures out there. And that's why as an investor, always stay invested. I just look to invest in what's working. In addition to owning long-term positions in brands I know and believe in. So I thought I'd just share that example with you guys today, just to let you know, just because the market's going down doesn't mean every single stock and sector is going down as well. And with that, that's pretty much a wrap for the Click Capital Daily Market Review this week. Thanks very much for tuning in, and just a huge shout out to everyone who's taken my anonymous survey. Really appreciate your time and your input. Got some really interesting opinions and feedback from you guys, helping me to better understand you and how I can make better content for you. And I'll share a bit of insight from this survey with you guys next week, along with an example of how AI has helped me increase my productivity and efficiency and how it could for you as well. And so anybody else who wanted to take this quick anonymous survey, just click the link below this video. Head on on over to my website. Only take 5 to 10 minutes. And as soon as you submit it, you'll be automatically redirected to my latest report, in which I've profiled 10 of the hottest stocks, small cap growing stocks, exciting stories on my watch list. One of them I'm already invested in. Others I'll be talking about on the channel over the coming weeks and months. So if you'd like to get instant access to this report, just click the link below this video, as I'm just about to pull this survey down this weekend. So this is the final reminder. If you'd like to help me out so I can make better content for you and get that report, then a big thanks to everyone who does that. Otherwise, have a great weekend, and I look forward to making more daily market reviews for you guys next week as we really get into the thick of it and approach this most important election. Thanks very much, and take care. Cheers.